Hello, everyone. This is your host, Akil Jabbar, and welcome back to another episode of SaaS District. In today's episode, we'll be talking about how to acquire, manage, and build a B2B SaaS portfolio. Today, we have our guest, Kevin Petersen, joining us. Kevin is a marketing automation specialist with over 20 years of experience working with companies like Charles Schwab and Wells Fargo. And he also had founder shares in a public company on assignment. Peter's SaaS experience includes growing a file-sharing platform to 7 figures in revenue in its first year, which was an award-winning music industry startup. He also runs several portfolio brands and companies that have realized over 50% year-over-year growth since the acquisition, which he now manages in his portfolio and investment firm, GrowthStack. So welcome, Kevin. Super excited to have you on our show today.
Thank you, Akil. Good to be here.
Awesome. So, we've had a couple of conversations before. We've known each other for a little bit. But for those in our audience who aren't familiar, what's your personal background? What's been your past ventures? And what was the motivating decision for you to start your investment firm, GrowthStack, where you focus on acquiring and growing B2B SaaS companies?
Sure. Yeah. So I'll start at the very beginning. I was actually born in the Silicon Valley before it was called the Silicon Valley. I don't want to date myself too much, but I grew up in San Jose, and just 2 miles from where Apple was headquartered and founded. And I just have entrepreneurship in my blood. Always have. I am one of those people that had popcorn and lemonade stand when I was a kid. So. It's always been, kind of innovative spirit has always been a part of me. I early in my career, I was actually studying music, and I was working in the music industry for a number of years. And my day job was marketing. I was also going to school for marketing, and I fell into a pre-IPO startup in the staffing industry. You had mentioned on assignment, and I was marketing director there for 8 years, and we did take it public. During the time that I was there, we grew revenue from 7 million to 63 million. Public offering was very, very, very successful. It's still trading today. Ticker is ASGN. It has about a $3.5 billion market cap, operating in 26 countries.
Wow.
So that's how my career started. And then from there, I had to make a tough decision when I left there about, do I go out and get another, quote unquote marketing job, or do I learned so much from that experience. I learned all facets of marketing. So it was everything. It was, trade show management and call center management and direct marketing and print advertising. It was all of it. Mm-hmm. I didn't really want to go out and get a quote unquote marketing job and get pigeonholed into, a single role where a company labels me like, hey, you're the email guy, right? And that's it. So yeah, exactly. I thought, I've built such a broad base of skills and experience that I really just wanted to venture out on my own. So I started consulting, and I started a marketing agency. And that's kind of how my career began. And then at one point, I sort of discovered that there was a thriving secondary market for online businesses. Mm-hmm. That was about 7 years ago. And I would say today, generally speaking, most people are still totally not aware of that dynamic, right?
Right.
And a lot of people today, including my own family member, I always joke this with people, that family members have a very clear understanding of what I actually do for a living.
Yeah, I still can't explain to my mom either. So
Exactly. So what I've discovered is that the easiest way to describe it is if you look at companies like Apple and Google and Facebook and so on, and Amazon, when they make an acquisition in the news, like if Apple goes out and buys Beats and spends $1 billion Beats, people know about it. It's in the headlines. People are excited about it. I don't know why they're excited about it. If they don't have any stake in Beats, they don't own Apple stock. Why do they care? I don't know.
Right. That's a good point.
They're excited. People get excited to hear about merger activity and acquisition activity. So the way I describe GrowthStack now is, and I do for a living now is, it's just, we're doing this thing. It's a similar dynamic as Apple Beats. The difference is if I go out and spend, $1 million or $5 million on a company, nobody cares, right? It's not in the
That's
news.
True.
Not buying household names. We're not chasing unicorns. We're just buying cash flowing businesses and, negotiating the best deal we can at acquisition and building a portfolio of these cash flowing businesses. And, I'll share with you just a little more about GrowthStack and then I'll pause. But it was 7 years ago when I discovered that, again, there was this thriving secondary market. My business has changed hands. I was super excited about that dynamic, that opportunity, and also how I could apply my skills and experience in sales and marketing to acquire and grow these businesses. So I would say the first year I was kind of off the rails, right? I was buying anything. I was just so excited. It's like, like first business that I bought on the secondary market, I actually bought it off of Flippa, and it was a tattoo blog. And I don't have tattoos, but I liked it, and I liked the model. And what I liked about it was that it was selling for $900 on Flippa, and it was making $300 a month in just AdSense income.
Right.
And I'm like, well, that's kind of a no-brainer, right? I get my money back in 3 months. So I paid $900 for it. I paid a developer $300 to make some improvements. And within 90 days, I had it up to $750 a month in revenue. So a business that I had invested $1,200 in was making $750 a month. And I was like, this is awesome. Right?
Right.
And if I can do that with one, I can do it with 10. And if I can do it with a $1,200 investment, what if I add a 0 or 2 zeros or 3 zeros, right? So That's how it started. And then really for the last 7 years, I've just been stair-stepping the business. And then at one point I did start inviting investors to participate so that, we acquire and manage, and the investors participate in, in the gains. So
very cool. And that first kind of, company you work with, the publicly traded company, you still own shares in that company, or did you cash out and use that towards
I did. No, I cashed out a long time ago. Yeah.
Okay, cool.
That would have been interesting to hold on to, but and I was a nerdy kid. I started investing in the stock market when I was 9. Looking back, there are companies that if I had held some shares, for the last, I don't know, I date myself too much, last 40 years, right?
Right. Yeah, for sure. Yeah, I still regret selling my Tesla stocks a few years ago. I don't know what I was thinking.
Yeah, right. Yeah, exactly.
Yeah. Cool. So now you guys have, I think, a total of almost 5 companies in your portfolio, right, within GrowthStack?
Exactly.
5 now, yeah. So I think most interesting for people is like looking back at, for me even, I always love to do look backs from the deals you've done. What would you say, you don't have to say the actual name, but maybe just kind of high level, what would you say has been like, both best acquisition, both from a financial and personal gain, and why? And I'm saying personal gain because sometimes they are profitable, but they're just so, tiring and time consuming that I don't think it was even worth the high ROI, right?
Yeah, that's interesting. So, there's a couple of things about that. So just because of my marketing background, I've been gravitating toward ad tech and marketing tech, MarTech platforms. Mm-hmm. So of the 5 businesses that we're operating today in our portfolio, 4 of them are ad tech, MarTech. Right. Mm-hmm. So that wasn't really necessarily by design. And, I do want to diversify our portfolio over time. But as I was building, it was very easy for me to assess, value and trajectory on these ad tech businesses because, I have that background to draw from. So I was able to look at it and say, it's almost like the Warren Buffett quote, right? Like buy what you know. Right?
Exactly.
So that's kind of what I was doing. I was like, well, I can look at an ad tech business and in 15 or 20 minutes, I can say, yeah, it makes sense. I can see why people would buy that service. Mm-hmm. Or no, I don't really get it. And let's move on, right? So,
right.
So the businesses that we've purchased, like I don't really, they're such a close fit to my like knowledge, my personal knowledge base, that I don't feel like they were that challenging to understand or operate. I think the challenges more are on just scaling, right? So in order for me to run a portfolio of SaaS businesses, and just for your audience, we're 100% B2B SaaS at this point. So,
Right.
Or like I mentioned, early on, I bought a tattoo blog, I bought content sites and e-commerce. I was dabbling in everything. It's Amazon FBA, Amazon affiliates. I was trying a lot of different models. Mm-hmm. And what I found was that for me personally, based on my background again, like B2B SaaS is where it's at. It's the only place where I feel comfortable placing investor capital.
Yeah.
And it's partly because of my background, but it's also partly because of the SaaS model, where you've got recurring monthly revenue. There's some stickiness. There's some pain of switching for the customers.
Right.
And then the other thing is you've got runway, right? So and that's really what this comes down to for me in building a SaaS portfolio, is that I built infrastructure to support these businesses, and it's all about SaaS affords you runway to look at changes in the marketplace, look at changes in technology, look at the changes in the competitive landscape. Is a new competitor coming on board? Is somebody falling off? Are they offering something different than you are? And all of those factors, with SaaS, you have time to react to those changes. Mm-hmm. You've got, like, in SaaS, you don't typically see SaaS businesses going from, where they are to zero overnight. Right?
Exactly. That's right.
Yeah. And in e-commerce, quite frankly, e-commerce and content sites, that can happen. I mean, a Google penalty or a change in Facebook policy, and all of a sudden your revenue, 75% of your revenue can be gone overnight.
Exactly. I guess it could happen with SaaS too, if you're sales driven and a client kind of makes up a lot of your revenue. But at the same time, you could make it up pretty quickly if you have a good sales process in place, right? And to win that back. Whereas, like you said, with the Google content site, you can't do anything, right? Here.
Yeah, exactly. Yeah, and then that's actually a good point you bring up. Like, we really, I shy away from businesses, acquiring SaaS businesses that have high concentration of a few clients making up 80% of the revenue. Mm-hmm. It's just too risky. So we look for proven models that have a broad customer base, again, so that even if your top 3 customers disappear, you're still fine. You can make it up. So
okay. And then I think part of due diligence is probably like a critical part, right? I think sometimes you get through due diligence and you get so far into it, and I think sometimes people feel there's if you don't continue, there's like a reputation risk, right? Because you've done all this work and people are now, the sellers depending on you, and people won't pull the plug on the deal, right? After a certain point. Even though the deal has that uncertain potential, or they have good metrics, there's just that risk. Looking back now, right? Can you share any failures you've had, that past transactions, that what would you have done differently maybe during due diligence that would have been helpful for you?
Sure. So, our due diligence process is pretty good. I'd give my organization, a good solid B+, A-. We don't always find everything, but we're pretty good. And we do also rely on, I'll give a plug for a company called Centurica, does third-party data verification or validation. So they'll do screen sessions with a seller to look at financials and Google Analytics, and you can get access to some of those things during due diligence. But it's nice to have a third party that actually does their own. They have their own process and they do their own validation. So for sure. I feel like between the work that my team does, and we do have a due diligence checklist that we follow on every potential acquisition. So we'll go through our due diligence, and then when it gets to a point where the deal looks real or solid, then I do bring in Centurica to do another pass at the business. Just so I feel like, the best case scenario is they come back to me and say, we don't find anything new. They don't find anything new that we didn't already find, right? Mm. But the value that they provide is sort of peace of mind that if they find a red flag that we didn't find, then it's like, oh yeah, okay, so there's something we missed. I'm glad that we paid them to do this, and now we know, right? But you make a really good point. I think, and I got a couple of thoughts about what you're saying about companies or acquirers not backing out once they get to they sort of hit a point of no return on the deal, right? Mm-hmm. So it is very easy for all of us as entrepreneurs to get shiny penny syndrome. And you start down a path, you're like, wow, this is the best business I've ever seen, right? Exactly. And you get like 60 or 70% into diligence, and you may see some red flags. It is hard to turn that off. It is hard to say, hey, we should be walking away from this, and then actually do it. So, a couple of things I'll share. What I've seen is that it's taken time for me to learn this, that, mm-hmm. What I've recognized now over the past 7 years is a lot of times there's a deal that we see that looks like the right deal, but wrong time. And I'm like, oh man, we're in diligence on this other thing, so I'm not going to, I don't want to chase that. Well, we already have something in pipeline, so we're just going to pass, right? Right. And I feel bad, like emotionally, I feel like, oh man, like maybe we're missing out on a good opportunity, or maybe the one that I'm passing on is better than the one that we're looking at, right?
The FOMO, yeah.
But what I've seen over the years now, like now I have enough experience to be able to say confidently that there's always another deal, and that deal that I passed on might come back. Like what I've seen is that it's not uncommon. Actually, more deals fall through than close, really.
That's true, yeah.
Right. So now I don't feel so bad if I pass on something, because I can't tell you how many times I've seen those deals come back, 8 weeks later, 12 weeks later, where the broker or whoever's representing that deal is reaching out to me again saying, hey, we had a buyer fell through.
So interesting. Yeah.
Are you interested? You want to take another look? Right. So, but the other thing I'll share with you is, for GrowthStack, we have an acquisition scoring model that we use. Mm. And I do recommend this to any buyer. And it doesn't have to be complex. It can be, you can have as few as 5 or 6 criteria that, you've just identified as these are my core criteria, and this is how I weight the criteria, right? Like this one attribute I give a score of 10, and this other attribute I give a score of 5, because this one it's important, but it's not as important as, the other one. So, set up your own scoring model so that you can apply some objectivity to the deal and kind of take the emotion out of it a little bit. Yeah. What it's done for me and my team is it's not uncommon for us to get excited about a deal that once we put it through our own scoring model, we'll see that the deal that we're really excited about is actually scoring lower than a deal that we passed on. So that doesn't mean that we shouldn't do it, but what a scoring model will do for you as a buyer is it gives you a point to reflect, to step back and say, oh, wow, like I love this deal. Like emotionally, I love the deal. It's not scoring that high in my own model. Like I built the model, right? And for some reason, it's not scoring as high. So the question it gives you that point of reflection where you say, okay, why am I excited about this? Why does this matter? Why are we pursuing it? And there could be very good reasons to still do the deal, but at least you have that checkpoint, to kind of put yourself in front of the mirror and say, is this really right? Right? And if it's not, it's not. There's no you were alluding to. There's no harm in passing on a deal.
That's right. So I think if you summarize both those kind of things you mentioned, I think that goes back to really just taking the emotion out of the decision, right? Because you said yes, there's this really good deal. You see the opportunity, you feel you can make a lot of money, you might lose out on it, but you have to be objective. Take the emotion out of it. It's okay, look, this is not the right time. I have to be able to say no. And then the second part to that is, okay, I love this deal. I see an opportunity. I see the upside, but objectively, these numbers are telling me this is not, something is not right here. So let's just take the emotion out and let me pass on this deal, right? Yeah, that's
exactly.
a good point.
Yes. Yeah. And just, the metaphor is the real estate market, right? So, I have colleague who loves to say, "There's always another view home." Right?
That's true.
It's just, if you're investing in real estate, when you start looking at a property that you think matches your criteria, it's easy to get really excited about it and just be like, yeah, this is what we want. But, and actually I'll share with you too. So the way we manage, we actually use our scoring model a little bit to manage risk and offer and terms.
Okay.
So in that example, and this would be true in real estate as well, right? So if there's something that you're excited about, but it's not a perfect match for your criteria, if once you recognize that, then you can say, well, okay, so we still like the deal, we still want to do it, but we're not going to chase it. So we're going to put what we believe is a good offer for that thing. Like we may offer a little bit less than what the seller is expecting or wants, or we may change the terms a little bit to mitigate risk a little bit. And if they reject it, they reject it.
Yeah.
And we're on to the next one. Exactly. So that's the other value of having, at least some written criteria for what you want to invest in.
Makes sense. And, before an acquisition takes place, like you said, timing is a big thing. And then there's also like the reason and motivation for the acquisition. In your opinion, when is the perfect stage and position, when either from a seller perspective, when is a good time for them to sell? And then also from your side, when's the right, risk and return for the right opportunity while still paying that fair valuation from your side?
Yeah, so that's an interesting question. I'll take a stab at, sharing the seller side of it.
Okay.
But the seller side of it is not as clear in my mind to me as the buy side. But on the seller side, what I've seen is that I can tell you when sellers do take business to market. And a lot of times it might be, a little bit late, right? Sellers probably should take if their intention is not to run the business for 10 years, then they should have a pretty clear understanding of the right time to sell and feel compelled to sell sooner than they probably thought they should.
Yeah.
And the reason is, what I mostly see on the buy side is that the sellers, especially with SaaS, I think this is more true with SaaS than with other online models.
Yeah.
With SaaS, a lot of the sellers are, founder, operator, developers, right? They are coders, whether they coded that site themselves or not.
Right.
They're coders, and they recognize the need in the marketplace. They took it to market. They went through proof of concept. They built a customer base. And what happens is typically they get it to a certain point and realize that they can't scale it, that they just they don't have the infrastructure, they don't have the experience, and quite frankly, they don't want to, right?
Right.
What I mean by that is, like, most founders do not dream of building a sales team and managing a bunch of sales people.
That's true. Yeah.
And they don't dream of building marketing funnels and drip campaigns. They want to build a shiny new thing, take it to market, and feel like, yes, I did it. Like, I thought this would be a good idea. I built it. People started buying it. It's awesome. And the time for them to sell is before that business plateaus. Right. So at some point, they're going to hit the ceiling on their own personal experience and expertise, and the growth curve is going to flatten. And so it's really hard. I think it's really hard for founders to recognize where on the hockey stick is the right time to get out. But typically they wait too long. They wait until it's plateaued and maybe even on a slight decline, instead of when it's going full bore. Yeah, upside, exactly.
And that's why they can get the higher valuation, right, than demand, and probably more interest as well. Yeah.
Exactly.
So I guess it's for good from your end, right? Like for you look at that, you're like, okay, perfect. They've kind of, now you get a better deal maybe, and slightly better valuation, and you can probably turn it around, right?
Well, that's exactly right. I mean, and that's exactly what our model is. Our model is to find those scenarios, those businesses, and then apply our infrastructure. So we have, skills, experience, and infrastructure to, accelerate growth again, or jump.
And what would you say? What would you say is one, like if you're looking at potential acquisition, what's like one factor or element that you said that gets you just super excited about opportunity? Is it growth percentage? Is it the market share? I know you have like a couple of factors, but if you would pick one, what would you say it is?
Yeah, so I'll preface that by saying I'm probably a little biased because of my marketing background, but most of the time it is the marketing opportunity. So, and what I mean by that is I can't tell you how many times I met with a seller and they're all excited about the product and, they built this amazing widget, right?
Right.
And they took it to market and customers are paying, the customers are happy. And then when I ask about their marketing funnels, I'm like, okay, so tell me, like, how big is your audience? Like, do you, I'm assuming you have an email list, a CRM, are you doing any text marketing? Like, what are you doing on the marketing side? And they're like, oh yeah, we got 100,000 contacts that are double opt-in on our email list. And then when I say, okay, well, how many times did you email them last year? They're like, I think last year was 2. It was 2 or 3. Last year was definitely, we emailed them 3 times last year. Right? And I'm like, okay, so to me, I get excited about that because I'm like, okay, so they like the hardest thing to do with an online business for anybody in any model, the hardest thing to do is to build an audience. And if you have an audience that you haven't monetized, that's an opportunity.
Right.
So more often than not, that's what I look for. Like for me, it's risky to go to a business that has 10 clients. They're doing a certain amount of revenue and it's mostly from 10 customers that could leave anytime, and they have a couple hundred contacts in a CRM somewhere. Okay, that's risky. Less risky is a business that has 100,000 plus contacts in their audience, and they just haven't monetized. They've never thought about it. They're so focused on the widget, making the perfect widget that they're ignoring. They're basically ignoring their audience.
Exactly. So, they just focus on the product, and that's perfect opportunity for you guys. Yeah. What would you say is the top 3 main ingredients? So that's from your side, but to get other investors, if somebody's looking to raise capital from other investors to get them on board to trust you in acquiring it, what are top 3 things you go to them and say, get them excited about the deal?
Yeah. So one is just getting back to having a clear investing thesis or acquisition model. You need to be able to articulate what you're what kinds of deals you're looking for and why, right? So, it's like there's the famous YouTube video about start with why. That really does apply to pretty much everything in business, right?
Sure.
So you need to be able to convey the why to your investors. Why are you doing it at all, right? And why are you looking for that type of business? How does it match your skill set, or why do you think there's a growth opportunity there, or whatever it is, right? So there's that piece, and then certainly diligence and trust and so forth is a key component. We've talked about that a little bit already, and then I think the third thing is just vision. And I'll try to articulate that a little bit with some real world examples. I went in, and this isn't the only time it happened, but I went into one seller meeting. It was an in-person meeting with a founder CEO, VC-backed company, and it was a really compelling deal. It was like a really good brand that was going to market. I'm not going to name it, but it was a really good brand that was going to market. Okay. And like a lot of developers would recognize the brand, right? So, that deal had enough attention between, the brand recognition and the VC backing. There were other PEs bidding on that. There were hedge funds bidding on it. And when I walked in and sat down with the CEO, I said, hey, before we even get started, I just wanted to share, like my team last week, we had a couple brainstorming sessions and we came up with a list of growth initiatives for your brand. And I know that, and their brand had stalled, right? Even though it's VC backed, it had grown to a certain point and then growth stalled. So it was highly profitable, but it wasn't growing anymore. I said, So we came up with some growth initiatives, and I said we came up with a list of 41 things, and here are the 7 that we would probably do first. And the CEO literally pushed his chair away from the table and said, you're the only guy that showed up with a vision for growth. You're the only one who's come in and shared with me tangible ideas on how you're going to revitalize the brand and the growth.
Nice.
Yeah. And to me, that's what, I would challenge any buyer to go through that process. There's really two things that they should think through ahead of an acquisition. I'm getting into secret sauce a little bit, but not too much.
Sure.
One is just being able to brainstorm and articulate your vision for growth for that brand. Mm-hmm. And it could be anything. It doesn't have to be complex. Again, you don't need to come up. You don't have to have that aha moment where you're turning it into a unicorn, right?
Right.
It just has to. It can be table stakes. It can be like, hey, well, they've got this audience and it's not monetized. Or if they had a strategic partnership with this other brand, sales would probably jump by 20 or 30%, right? Or it could be that this business. I mean, I have situations in my own portfolio where I've got one brand that before we bought it relied very heavily on affiliate marketing, not very much on direct sales. And I've got another brand that has always focused on direct sales and hasn't really focused on affiliate marketing. So on the one, we're adding direct sales, and the other, we're adding affiliate marketing. It's like it's not that hard, right?
Right.
You should be able, when you're looking at an acquisition, or if you're talking to an investor about a deal that you're aware of, you should be able to articulate, like, you know what, like, here are the top 3 things that we're going to focus on first to jumpstart growth.
I agree with that.
And
nice.
If they pass the sniff test, people will, investors will participate.
Makes sense. Yeah, they want to see growth on their return of the money, and if the valuation is right, and they feel highly confident in your trust and ability to execute. I think that's
exactly right.
Yeah. So overestimating, the synergies, the growth opportunities, even including myself, I come in this as an optimist in these deals, but I see that, many times over where you have millions of dollars on the line and you maybe overrate the business on what you think it can, where the potential is. But then you're stuck with this business for the entire life cycle, right? Because it's hard to recover, or there's just, a lot of issues you're dealing with at that point. Do you have an approach on how you estimate that upside potential, the growth opportunity, or are you doing any tests beforehand, before actually taking on that investment?
Yeah, so as much as possible, we do try to model growth, pre-acquisition, and whenever a seller will allow us to do so, we will ask to talk to some of their customers. We definitely do look at. I think a lot of it is part of the due diligence process, and there's risk mitigation that happens, before an offer is made, before we get to an LOI. So we ask the seller for all of their trouble tickets from like a recent period, like the recent month. Show us all your trouble tickets for last month. Mm-hmm. Or let us read all your customer service chats. There are ways to get some insights. Like the more insights you can get from the customer side or customer perspective, I think that helps to reduce risk or surprises post acquisition. Mm-hmm. And then there are ways to mitigate risk during the deal phase where, you should at least ask if the seller is interested in retaining some equity.
Okay.
Even if it's not your intention to keep them on or to let them keep equity, their reaction to that is or can be a pretty good indication of what they think about the business.
That's a good point. That's a very good point.
Yeah, if they're like, oh man, yeah, I'd love to retain 15% because I believe this is an amazing business and I just need to sell because of X, Y, and Z and I got this other project or whatever, right? But if they're like, no, like I don't know, I'm out, man. Good luck finding me in Tahiti.
Yeah.
So that's an indicator. But I think your question really is about like what happens if you actually do buy the business and then you find out that it's a dog, right? You're like, oh man, even though we had a scoring model and even though we went through due diligence and we checked the boxes and we had a third party, auditor or validator come in and look at the business and we structured the deal just right, it's still not as expected. Right. Yeah. And so, so again, I think to your point, there is value in cutting losses. VCs do this all the time. right? VCs go into every acquisition assuming that 6 out of 10 are going to fail, right? They're hoping that if they buy 10, 6 out of 10 are going to be horrible. 3 out of 10 are going to be just okay. And 1 out of 10 is going to pay for the next 20.
Right, exactly. I don't think we're that model, but yeah.
Yeah, it's not my model either, right?
Yeah.
But it's okay to have that. It's okay to have that reality check and that lens to say, hey,
sure,
let's cut our losses on this one. Like the opportunity cost of keeping it in the portfolio is greater than, like
trying the next deal, focusing on another deal. Yeah,
exactly. Yeah, get it out. You don't have to think about it anymore. Redeploy the capital, lick your wounds and move on, right?
Yeah, it's also something I mentioned, right? Whether, like you said, you're working on $1,000 deal or $1 million deal. I mean, you only have so much time in a day. And if one is just underperforming, like you just, one is growing, 10% month over month, and the other one is just declining, and you're trying to turn it around. Like, do you focus on the other one where you get more upside and more, time for return on your time? I guess it's hard to take on that loss, though, right? I guess at some point where, but I guess if you can accept it and move on, then that's a strong skill.
Yeah, it is. It's hard. It is hard to juggle that. And I'll tell you, just from my own experience, I'll tell you what has been really hard for me building a portfolio. Okay. And so my model over the last 7 years has been stair-stepping, right? So like my very first business, like I mentioned, I put in $1,200 out of my own pocket. It wasn't like super risky, and the reward was relatively high percentage-wise. It wasn't a lot of money, but it was a win, right? Yeah. But what happens is, as you're stair-stepping, the smaller deals become less and less interesting, because for the reason you just said, like the next deal was like, 10,000, and then the next deal was like 60, and then the next deal was like 140, and then it was 500, and then it was $1 million, right? So as you're stair-stepping, the small deals, it's hard for you to put time into them, because it's just what you said. Like the tattoo blog is an example, right? Like that business making $700 a month isn't that interesting when you've got a business that's doing, 6-figure MRR.
Exactly.
No, it's not the same thing, right?
Right.
And if you put your time into the larger asset and get 10% growth, it's very different from putting your time into the smaller asset and getting 10% growth.
Well, the playbook is similar, right? I mean, you're applying, marketing, whether it's content, whether it's SEO, whether it's Google Ads. So the time to set up that kind of infrastructure is probably exactly the same, right? And you might as well spend on that.
So, and I tell people that all the time. Like, running a $100,000 business is not 10 times harder than running a $10,000 business. And running a $1 million business is not 10 times harder than running a $100,000 business. I think that's true until you get to about the 10 million point. And then there actually is a different dynamic. Right. Once you get up over 10 million, I would say an acquisition size. Yeah. At that point, once you're 10 million and up on acquisition size, then you really start. You're getting into a different. It's starting to look more traditionally corporate, right? You practically need an HR department at that point.
Right. Exactly.
I mean, I know people personally who are blessed enough to have businesses that are multi-million-dollar businesses that they're running with a team of like 7 people. Wow. But that's the exception, not the norm, right? Right. Typically, if you get up into that, once you break the into the 8-figure range, there's more traditional structure that has to be applied. Right. But before that level, it's exactly what you said, where it's the same formula for each one. And so if you can get, like we were discussing, if you get, 20% growth on a, $5 million business, that's way more valuable than getting 20% growth on a $1 million business.
Exactly.
Which is why we stair-step in the first place.
Yeah, it's a good piece of advice. And then when it comes to valuation, I want to talk a little bit about that as kind of a final point here. Sellers, I think they come in, especially they're so attached to their business, right? And they probably overvalue, they come to you with their high expectation of what the right price is. But then when you guys are coming in, you're calculating your valuation, you're assuming upside growth of the company, what the potential is.
Mm-hmm.
Do you have ways of how to overcome those conversations with sellers to educate them, or, come back to expectation of what the right value is,
Yes.
and then, not overpay without, losing the deal and make a deal happen? Yeah.
Yeah. So, one of the easiest ways that I've seen to kind of bring, at least get into the same, same space as the seller, is to quantify for them what your investment means, right, in that business. So what I mean by that is, let's say, and actually one of my business partners articulates this really well. So I'm basically I'm plagiarizing. I'm using his how he conducts seller calls.
Okay.
And it's super valid. And so if a business is selling, I'm just going to make up 5X is a good round number. So like, let's say they're selling at 5X on net income. That business, the seller might want 10X, and you're not willing to pay 10X, and you might not really want to pay 5X. But the way that you put that in perspective for the seller is to say, hey, seller, if I pay 5X on net income after seller discretionary earnings for your business, what that means is if all things remain equal, it's going to take me 5 years to get my investment back.
Right.
And in technology, there are 1,000 different things that can change in the next 5 years. So I need to mitigate my risk. And you can ask. Just ask the seller, like, does this sound fair? Is what I'm saying making sense? Is it resonating? That, I'm taking on the risk of, I'm helping you get cash out of your business that you built. And I'm taking on the risk that all things will remain equal or better over the next 5 years. And best case scenario, I grow the business and I can recoup my investment in 3 years. Right. Or whatever the numbers are. But if you put it in that perspective for the seller, it helps them to kind of quantify, like, oh yeah, I can kind of see why the buyer is placing the valuation that they're placing. I can kind of see why, like, if they don't have a clear path to 3X or 5X or 10X the business, then, and as the seller, it's really on the seller to present that case. Like, hey buyer, here's how you can 5X this business. Right?
That's right.
If they can make that case and it's real, then of course it's going to get a higher valuation. But typically you're meeting with the sellers who are like, I've got 3 projects I'm running. This one's doing fine, but it's kind of plateaued. I want to take the cash out of this one. I want to invest in this other one and really, jumpstart that project. So they're typically, what I'm seeing anyway, is that the sellers are not hard selling me on the super value of the growth. They just want to get as much cash out as they can.
Exactly.
So, unless they can present a clear case that says, I can show you how you're going to get your initial investment back in a year and a half, right? Then
that's true.
It's hard for them to justify the higher valuation. It's, make them justify a 10X or whatever the number is.
Yeah, that's a good point.
10X is a little extreme, but you're getting not at this rate. Territory there, but yeah.
Exactly.
Yeah,
unless they're growing, say, look, I'm growing 200% year over year, and you're not going to get it in 5 years. You're actually going to get it in 2 years, as long as it remains the same. Then cool, maybe we can have that. Makes perfect sense. Yeah. Cool. Kevin, who have been, who or what have been, 3 resources, mentors, or people in your life that you say have been instrumental to your success or help you grow, along the way?
Sure. So, first, I'm just going to mention the Rhodium Group that I know you're familiar with as well.
Sure.
So, are you actually in Rhodium right now? I can't remember.
I'm in the group. Yeah, I'm very inactive on social media, but yeah.
Yeah. But so Rhodium. To me, like all the connections and resources and advice I've ever needed, I can easily find in that community. Yeah. And it's not a huge community. It just happens to be really, really strong.
It is, yeah.
the resumes that you see from the Rhodium members are all very impressive.
I know, it's an all-star
So
crew
it's
there.
just, it means a lot to me that, so I guess that would be, advice for people. Like if you have access to a mastermind, I mean, just a little background for people who don't know Rhodium. So it's basically a community of online entrepreneurs. So think of it as sort of a mastermind. There are actual masterminds that run monthly within Rhodium. So for anyone who's looking to build a portfolio of businesses, if you have access to a mastermind, it's a good idea. You can always start one. I mean, reach out to people that you know and respect and so forth, and it just means a lot to have people that you know and trust, so you can bounce stuff off of on the plus or the minus, right? I mean, the real value of that is being able to bring a problem to that group and say, hey, like when you have that, bleep moments, right?
Exactly.
It means a lot to be able to go to the group and say, hey, this one thing just happened in my business and I'm not sure how to navigate this. And somebody in the group will either have an answer because they've experienced it firsthand, or they know somebody who can help you. And there's a lot to that.
I think the value is unbelievable, because the experience that's there, right? People who've been down that path that can literally save you. I think I won't say this lightly, like millions of dollars. I've almost went down a deal at some point. I was going pretty deep into it, and I was about to make an offer, and I felt I was not 100% sure. I went to somebody else who's been down that path, and he just pointed out something so clearly to me that I was like, everything just made sense, that I had to pull out of that deal, and I was so grateful for that, right? And all it took was just one conversation and his experience that I would never had, right? So
yes, exactly.
Yeah, cool. Kevin, what does success mean to you today?
So really, for me, I've taken the last 7 years to learn and build infrastructure, and so without oversimplifying it, for me, it's just more of the same. Like, I just want to be able to continue to build on what we've done so far, and deliver. It's partly, I guess it's really three-pronged, right? So one is just, like anybody, I just want to be successful in business. It's rewarding. It's personally rewarding and fulfilling to build a business and see it grow. And another is lifestyle. Like, it means a lot to me, especially during this crazy, pandemic era, right? Where, like, when lockdowns happen and people are like, oh my God, I'm going to have to work from home. I was like, I've been doing that for years, right?
Exactly.
It's like, I'm actually at my office right now. I'm the only one here. But it means a lot to me that I have businesses that operate 24 hours, and I've got resources in multiple time zones. And really, I can work anytime from anywhere that I've got an internet connection.
Exactly.
So the lifestyle piece is pretty amazing.
Nice.
And then the other pillar would be just delivering returns for investors, right? So, I mean, to me, that is also super rewarding, is having other people share my success. And,
Absolutely.
Just full transparency, like, we haven't done everything right over the last 7 years. We've had some hits and misses. So there have been some really, it's the life of the entrepreneur, right? Where the good days are really, really good, and the bad days are really, really hard.
Yeah.
But we've been pretty good so far at delivering returns and protecting investor assets and building on a model. Our model today is stronger than it's ever been.
Okay.
So, the next thing for me is just being able to actually go back to investors and say, hey, like, I don't know when there's really like a we've done it moment, right?
We made it.
Because that's always changing.
Exactly.
But, just having those times, like I sent out an investor update 2 weeks ago that was, it was just very exciting. I was able to show that, hey, this business year over year, like, it's up X%. This other business, this is the growth curve. This other thing, this thing was going bad, and now it's not going bad. It's going good. Nice. Right. So being able to deliver those kinds of reports and say, wow, like, the model is coming together, and you will be rewarded for this. And to me, on a personal level, it means a lot to me to be able to say to investors that, hey, you're actually participating in the upside, just like we said.
Exactly. You get to deliver what you said. Yeah, I guess that's pretty. I feel the same reward as myself every time I deliver that. So cool. Kevin, final question: where can the audience get in touch with you? How can they learn more about what you're working on, or if they just want to say hi?
Sure. So certainly you can email me, Kevin at GrowthStackInc.com. Feel free to visit our website, GrowthStackInc.com. It's really easy to find me on Skype, actually. I always kind of have Skype running in the background. I was not an early adopter on Slack. I still use it, but not. But really, a very easy way to ping me is just find me on Skype anytime, for almost any time day or night.
Okay, awesome.
So my Skype ID is kevin.petersen90. 90. Petersen is SEN. Those are probably the two easiest ways to reach me, and certainly don't be shy. I love talking with fellow entrepreneurs and business owners.
Awesome. So we'll put a link to all those ways to contact you in the show notes. So thank you so much for jumping on, Kevin. Always nice chatting with you as usual. Thank you all for watching this episode and joining SaaS District today. Don't forget to like, subscribe, and hit the bell for future episodes where we interview top leaders in the SaaS industry. If you're a SaaS company looking to grow and unlock the true value of your business, get in touch with us at Horizon Capital, and myself or one of our consultants will provide a free assessment to help you get there and hit your goals. If you have any feedback or suggestions for this podcast, please comment down below and help us improve our content for you all. Thanks again, and see you on the next one.